Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good afternoon. Ira Epstein of Lynn & Associates with your agriculture update for this Tuesday, the 4th of April, 2017, about 1:30 p.m. Central Daylight Time. So as we look at the markets, today you're giving back a little bit in the corn. Remember, it's been on a move to the upside. One of the things in the morning that I've been mentioning to clients is the Bollinger Band top is where I thought some hedging might come in against the 370 level here in the May corn. Seem to be getting that. Now, obviously, you might want to start looking at further back options if you're a real farm hedger, but as a speculator, that's a resistance point. The wheat market's still not looking good. In fact, we sent out one of our charts of the day today on Minneapolis wheat that still looks low. And, you know, in our offerings, if you ever want those, just click it on. But something to see, because it does say if the markets give up the ground here, be careful on the downside. And the bean complex, stabilizing is about all that you can say in the market, because so many people still think that the acreage numbers that the USDA gave were not as high as they should be in the in the soybeans, movement of corn to soybeans. I also saw that the FC Stone numbers on the Brazilian crop seems to be growing again. So just different things that you have to watch as you're paying attention here. Now, as we look at the soybean market, you've gone from 1080 to 936.5 now. Excuse me, that's a new low for the break as it's gone down. And you can see you're in a previous area that the market did find some support at. So just be cautious, because you're at a zone you can bounce from. The question of, obviously, is last year in the June time frame, in the April, May, you were going up, and this year you're going down. So it gives you an idea of what people think, and I think that's important. As we take a look at a close-only basis, I haven't seen today's close yet. It appears it's going to be just a shade lower than this 38.25, down around 37.75. They'll post it in a few minutes. As you can see how the chart looks, it's just leaking away. That is the term I used for you yesterday, and it hasn't changed. And you still have a pattern where the apexes of these highs on the swing line study, and that's these brown lines that come with our charts, by the way, lower highs, lower lows, still very bearish. Where are you in terms of moving averages? One of the things I told you is this 18-day average is probably going to challenge and get under the last apex of 976.5. Could happen as early as tomorrow. It'll be in that neighborhood, I can tell you that. And as that occurs on rallies, that'll continue to drop unless you had a monster one-day rally, and it will be your next resistance point. In terms of what the market's doing, it's riding the lower Bollinger Band. Now, what do I mean by that? You see these black dashed lines and them up here? They're Bollinger Bands, part of an algorithm designed to keep the market trading within the bands 95% of the time. How some traders use it, including me, is I look at it as prospective support, prospective resistance. Got it? That's how I view it. And because it travels on it, like it's doing right now, that is a very bearish situation. I label that riding the lower Bollinger Band, and it's often accompanied by stochastics, momentum that converts itself from being oversold to locking in a trend. And that's exactly what you have here. That ends when the red line gets over 20. Now, sometimes when you're this locked in, instead of momentum being ahead of price, price can get ahead of momentum. So always be careful of that when you're trading these embedded readings, but there's nothing friendly on this chart. And as long as this stays here without a piece of fundamental news to change the game right now, I would believe that the rallies will be well sold. The same thing is happening in the meal market. As the market's coming down, it's moved again to the right-hand side of the Bollinger Band. The other day we had two of the days in this market where you were under, same thing in the beans. And if you look at yesterday's video, I think I was talking that I give roughly a percentage point to each of those days. So you had a 3% chance of staying under the Bollinger Band. Well, as you can see, you're back over it, you're back over it. That's the point. When these things lock in with the embedded reading, I don't expect big rallies unless you're going to get a trend change or a monster correction that calls for the end of that leg of the downside. The soybean oil is just plain oversold. It did not embed. It's back down to the lower Bollinger Band. It got through it today to 31.23, came back, closed 31.43, so about 16 points off that lower band. In the corn market, this was the area I was looking for the resistance to come in and see professionals hitting the market. It's exactly what's been occurring. Doesn't mean there's any magic up here, but that Bollinger Band's been the area. Now you're back under the 100-day average. The first support should be the 361.25 zone. You are not trending. That's the problem. You have lower lows and a higher high and momentum that is fading quickly as the market was going up. In the wheat market, the battleground is crystal clear in that it's the 18-day average of closes. 3 days in a row you've hit it. You have not had the momentum to get up to the 100-day average of closes. In this time frame, what's happened in the slow stochastics is they've worked themselves to close to getting out of oversold, but not there yet. You still have a 28 reading on the D line, so as long as that blue line, and that's the D line, is under 30, the market, as I term it, is still oversold. In the sugar market, you're embedding again. How many days? Well, today both numbers are under, as you can see, 20. Yesterday both numbers were under 20, and the day before they were. So you're now embedded, which means rallies will be probably, I can only use that word, probably find willing sellers on them until you lose the embedded reading like you did back here. And when you lose it, the market often, the word is often, not always, tries to make a run at the 18-day average, which it tried there and failed miserably to do. In the coffee, you went back down today, hit the lower Bollinger Band in an oversold condition, which means support should come in at 136.35. You round up since price is falling to it, and here's the market back to 137.75. It means the pros, in my opinion, were taking money off the table, covering their positions. The cocoa market's trying to establish an uptrend. The problem it's having is momentum's not going with it. You can see it's still pointing down here as prices are struggling to get up. What you don't want to see are prices under 2060. That would negate this attempt. I think the pros are buying against the 18-day average with stops under that number, trying to get prices a bit higher, maybe as high as the 2160s. The cotton market just suddenly fell apart yesterday, and away it goes today. Next support, the 100-day average. Now you have 2 days in a row under the lower Bollinger Band. So there's only a 3% chance, as I view it, that the market will stay under that Bollinger Band, but it could do it. There's nothing magical. Clearly you're not trending, and clearly you caught a group of people that got caught on this day. As the market had rallied, actually it began the day before, it continued, and for whatever reason, the market just let go. It's a pretty nasty trap on the bulls at that point. In the cattle, you've turned the trend down. It's now official, on my work at least, in a downtrend because the swing line has lower highs, lower lows under the 18-day average. It is not oversold. Momentum is pointing down, and resistance is rather clear at the 110.30 area. In the feeder cattle, you fell right back and you settled right on that 18-day average of closes. I could say that you've got the lower lows, lower highs, which you do. I can't say it's yet a confirmed downtrend because you're not under that 18-day average, but it won't take much to get under that, and momentum is pointing down. Nothing looks good on the chart at this point, and the hogs have been breaking rather hard. They gave up this 80-cent area, and that's going to be a very hard element to get back over. The market now looks like a top of maybe important magnitude is actually in place. You know, we talk in the grain market so much about what happens, and part of what happens is because of the seasonals. Now, we know we come out of winter, we get the ground ready. As we're getting our ground ready, the southern hemisphere is getting their harvest going, and all this comes to play with seasonal trades. Now, that doesn't mean seasonals work year in and year out, because fundamentals, ending stocks, like we just said, all come in. And as I showed you in the soybean market, you went up in last year in the summer. This year you're coming down, so there's a change. But what the more research does is it looks and gives you an idea what 5, 15 and 30-year patterns have looked like, the specific seasonal dates that the market often bottoms on. Even if it's in a bear market, it tends to get a bottom in different areas, and you can take it from there and make some decisions with. It's a trading tool. I certainly do not recommend that on its own, because a trade has worked, let's say 90% of the time, that you just go blind into that. Always have other work with it. There are many disclaimers. The biggest is past performance cannot guarantee future performance. It's nice to know what they do and where you work. So what the more research does is they're going to give you a 2-week trial. We're going to send you, or they will, an email and a user ID. You go online, you can read all the reports, you can play with their interactive charts. What do you have to lose? I've been using this just personally. I think I've been on their roster of paying them for 30 years. So that gives you an idea that I use. It doesn't mean that it's the right thing to do, but it's there. Spreads, the futures markets, maybe you get some option strategies, all there. How do you get it? 866-973-2077. My staff will take everything you need and take it from there. You can go to our website. You'll see our carousel of free offers. If you're watching me on YouTube, you'll see an icon right here. Click on it. The form will appear, and away you go. I'm Ira Epstein. Thanks for listening, and I'll see you tomorrow.